So without further ado, we're going to kick off with our review of the world markets. And we're going to find out what's happening out there. And of course, you would want Morgane Delledonne here, for Head of Investment Strategy at Global X. Are you there, Morgane?
Yes, hi, very good morning.
Good morning. And of course, John Mullins is with us, Vice President of Multi-Asset Product Strategist at PIMCO. John, welcome.
Good morning, everybody.
Back on the advice show again, it's Ava Sun-Wai, Fund Manager at M&G Investments. Come in, Ava. Slight delay. I'm certain you're on your way to us, though, Ava. And we want Laura Biancato, of Executive Director at Morgan Stanley. Are you there, Laura?
Good morning. Great to be here today.
Fantastic. Good to see you. Kevin is back again. Kevin Thozet, who's a member of the Investment Committee and Portfolio Advisor at Carmignac. How are you doing, Kevin?
Great.
And back again, it's Ben Mackie, Fund Manager at Hawksmoor Fund Management. Greetings, Ben.
Morning, all.
A huge cast of characters for us this morning. It's all about inflation. It's all about the energy crisis. But we've got geopolitics and now we've got domestic politics going in. What is making you scratch your head the most when it comes to the overall portfolio management out there? Ava, why don't you kick us off?
Hi, Dan. Can you hear me?
I can hear you indeed, yes.
Brilliant. Obviously, as you said, lots to scratch heads about. I think, obviously, given the inflation narrative has been running over the last, day. Obviously, everyone's still looking very closely at central banks, wondering, how they're going to tackle not only inflationary worries, but also the potential risk of recession that's, becoming more and more priced into markets. I think given the volatility, given that, well, it seems like the only guarantee really that we're going to have is volatility, but given, especially in bond markets and FX markets, I think what makes me worried is liquidity risk. And I think the definite lack of liquidity that we're seeing in the market, I think that it makes fluctuations a lot more inevitable. It means that the ability to execute, your economic views or your portfolio that bit harder. So yeah, I'll summarize that quick answer with, I think my main worry at the moment is liquidity.
Interesting. A lot to unpack there, and within the first 60 seconds, dropping the R word straight in there. And Kevin, have you an interesting statement there from Ava that recession might be priced into the markets? Do you think that's the case from your thinking?
Well, I guess as usual, it depends what you're looking at. If we look at equity markets, probably not. Again, if history is a guide, equities have probably another 15-20% to fall should we get into a recession over a very, very short period of time. If we look at other fixed income markets, notably, well, we can see that there's some form of, I would say, a cap on the US 10-year bond yield. So, this also gives you, I guess, some indication of, how much of a downturn is priced into fixed income markets. And then if I look at credit markets, and notably on the high yield space, we've clearly have seen credit spreads and bond yields clearly moving into, I'd say, recession territories. You get a heavy level of default to be losing money when investing in high yield markets nowadays. Again, with recession, usually the question is not if, it's more when, I would say. So at Carmignac, we do not believe that we will be heading into recession over the coming, I'd say, month. And we have had the testimony of this with the latest job figures last week in the US, notably, which are particularly strong. In Europe, I guess the recession is much more a question of politics and whether gas will effectively being cut off or not. Should this happen, yes, this will likely trigger a recession relatively rapidly in Europe because of the negative impacts on the consumer, but also because of potential shutdown in activities in some industries as well.
Morgane, are you slightly more positive than Kevin on that theme, or are you or less so?
I think as a market, I do expect the corporate earnings, the Q2, to give more indication on whether we will see a sharp recession or more of a soft landing. For now, I think that's mostly what is not priced in the market. The Fed's increasing interest rates, ECB tightening, and so on. The central bank side is probably mostly priced in, but what hasn't been priced in is the damage from high inflation on corporate earnings and profits. So I think we have to wait for these guidance to kind of assess whether we will have this V-shaped recession or a soft landing. I would be in the camp of saying more of a soft landing, because even if interest rates are rising, they're rising from a low base. Corporate earnings, at least from last quarter, they were quite strong. CapEx is still positive. There are lots of positive, but I do agree with with the other panelists here. A lot of geopolitical risk, a lot of volatility in the market. So that would probably point towards more defensive type of assets in the coming months or so. It's very, very difficult right now to predict, because most of our indicators are lagging in terms of signaling a recession. But I do think that the recession fear are going to continue to build toward the end of the year.
John, is that a whiteboard behind you? And if so, has it got a V-shaped recession plotted on it?
Yeah, I can draw the exact pattern if that's useful. Listen, I think recession risk has clearly increased, and for Europe and the US, a recessionary environment is more likely than not. I think what really matters for asset allocation portfolios today is what type of recession do we see, right? Do we see a recession in which inflation comes down and proves to be sensitive to growth, right? And in that world, that gives central banks, policymakers a bit more space to accommodate and maybe take their foot off the gas in terms of interest rate hikes. The big risk is that we see a recession in which inflation remains high, and that really kind of ties the hands of central bankers. And in that kind of environment, allocations to things like gold, allocations to things like inflation-linked bonds, they can do very, very well. So I think it's really more than that. There's a few strands to this, right? It's more than recession or no recession. It's, as the other panelists said, it's how deep is that recession? Is it a kind of soft landing, or is it something a little bit more severe? And again, I think we will see some evidence of that in corporate earnings as we move forward. But also, is it a recession in which inflation comes down and that can be dealt with a little bit more easily? Or do we see that stagflationary environment and one in which the things that are driving inflation are less sensitive to growth factors, and that can be quite a precarious environment, I think, for asset allocation in markets more broadly, and one in which you need to think about broadening the toolkit and diversification a little bit more outside of just equities and fixed income.
Ben, are these the same things on your watch list? You're nodding away there.
I mean, yeah, so a major caveat in everything I say is that we don't spend any time really trying to guess what's going to happen in the future. The depth of a recession, whether we get a recession, I think incredibly difficult things to predict, and then difficult to, even if you know what the future holds, to understand how in the short term asset markets will respond. I think it is fair to say that the narrative has certainly shifted, and we're starting to see markets pricing in a probability of a recession, and that's really what we're really concerned with. What are capital markets pricing in? And as Kevin was saying, we have seen spreads move quite a bit wider coming into this year. Returns from the bond market sort of horribly negatively asymmetric, with very, very low yields in benchmark bond markets, credit spreads very, very tight. And as I say, we have started to see a bit better value coming in, so high yield spreads moving out to sort of 650 basis points.
Ben, can you explain to the advisors out there and for me what the implications of that are in practical terms?
If you just look at it, the bond market typically gives you the returns are typically, your upside's typically capped, and your downside is often greater. And certainly in the start of 2021, we came into 2022, with the sort of returns available from the bond market being very, very low, and as I say, very, very negatively asymmetric returns. Now, as spreads widen, you're effectively getting compensated more for taking the risk of lending to a corporate. So looking across some of the high yield and investment grade bond funds that we consider, your return prospects over the last 6-7 months have effectively doubled. So we can find very, very actively managed investment grade credit funds. And this is quite remarkable, delivering sort of yield to maturities of 8-9%, which is stunning, I know, and probably double what the benchmark's offering. But we're in an environment now where investors are being more, compensated for taking those additional risks of lending to corporates. And of course, within investment grade credit, default rates do tend to be pretty low. We're still not mad about the bond market. I don't want to give that impression, but the return prospects have certainly improved from where we were at the start of 2022. And I think there's also pockets of value emerging within certain equity markets as well. As a house,
Laura, are you still with us?
Yeah, yeah.
There you are. Do you agree with the assumption that a rising rate environment is here to stay? And if so, do you think that there are certain asset classes or investment styles that you're going to be focusing on as a consequence?
Sure. So I believe central banks, what we believe is central banks will continue increasing interest rate, and it's a matter of inflation. So we believe the inflation will remain sticky for a couple more months, but the food and goods start to be a bit subdued. If we divide inflation in the different subcomponents, we find food that in our view, we see from data, has already peaked. So for instance, agriculture prices, fertilizer prices, that can be a proxy. They're kind of sliding down in terms of pricing. If we believe energy is a bit trickier. We believe energy will stay for the first part of, until the first part of 2023 at least. We saw, for instance, Russia with state-owned Gazprom that cut gas supplies to Germany by 60%, to Italy by 50% through Nord Stream 1 pipeline. So the base effect will start and will last a bit longer, also in the first part of next year. If we look at transport on the same side, even if we see car pricing start to be stable, we'll see turning to negative contribution on one side. And finally, shelter inflation, everybody's speaking about that. It's what we see is going to be limited in our view. It's the rents, house prices that we believe will be harder to accelerate from years. So our base case scenarios, we expect the Fed to maybe shift away from being poorly watching on the inflation, and also to start looking at growth later on this year from September. What we'll see is that we had the last print on Friday with a US job that added 3,000, 72,000 jobs. So with a jobless rate of 3.6% is quite low. And the next data that the market is looking is the CPI inflation on next Wednesday. So this is as regard the US. Europe, as we discussed, is more subject to recession risk before the US. US economy proved to be quite more resilient, and also Europe is much more linked to gas and linkage with Russia. So on the same side, we see still the ECB sticking with the guidance and potentially rise interest rate by 25 bips in September. And finally, as regard the Bank of England, again, we had a really strong print in terms of inflation, and that it was 9.1%. We saw ICE prices, the faster rate increase since 2004. So we still believe that in August, the Bank of England will increase rate another 50 bips. So this is kind of our view. So we'll continue to see increase of interest rate until inflation will start to come down.
Okay, so I've got a question coming from Chris Spear. Thank you, Chris, for starting us off. And Ava, I'm going to throw this one to you to start with. Chris says, basic monetary economics tends to say that if you throw money into the markets from QE or the pandemic, then it ultimately leads to inflation. So putting aside the Ukraine situation, how were fund managers prepared for inflation before it came along? Were you guys plotting for inflation coming before it happened?
I think that's a really good question. I think there were two sides to that. One, yes, you have the typical kind of monetary economics that, you know, we're all taught that obviously QE equals inflation. I think the difference, as others have alluded to, was that the base effects have been so strong. So obviously we were coming from, decades of a regime where we had, very, very low inflation. We had kind of very easy monetary policy for a long time. Bond yields have been falling for, 30 years. We've had globalization, technological progress, aging populations, all of these factors that have driven inflation very low over a very long time. So it got to, as fund managers, we got to a point, so we watch break evens very closely. So what markets kind of expect inflation to be. And we use that a lot when we look at valuations for, inflation linked bonds or derivatives that we can use to express inflationary views. And for us, yes, we expected some level of inflation, because you expect when central banks, during the pandemic were extremely accommodative, at some point, you don't know the timing, but at some point they're going to have to withdraw that support, both on a monetary side and also on a fiscal side. And that likely that will be inflationary, because, they're going to have to do that because they're trying to boost growth and trying to boost inflation. But on the other side, we also saw break-evens very, very low. In Japan, we actually had negative break-evens at one point, which, to us is a massive buying signal for inflation-linked bonds. And it's not necessarily a purely inflationary view, because obviously Japan has its own kind of regime that's very different from ours and some of the other Western economies. And they've had very low inflation for a long time. But so I think on some level, we were expecting it based on monetary policy, but also on looking at valuations available in bond markets, inflationary markets. I think there were also strong signals that inflation expectations were just have been extremely low for a long time. And, when you get a shock to the system like the pandemic that also creates supply chain disruptions on a global scale that we've not really seen before, yes, I think you do expect some sort of change to that inflationary trend that's been happening for a long time.